Welcome back to the deep dive. Today we're doing something a little different. We're going to dissect a live trading session on the microDAO, the MYM.
Yep.
And I want to be clear right from the start, looking at these logs, this is not a victory lap. It's not about, look how much money was made.
No, not at all. This is a mentorship session.
Right.
We have the logs, the notes, everything. We're digging into the why behind the clicks.
The messy reality.
That's it. So let's set the stage. It's pre-market.
What's the context?
The London session had already set a really bullish tone. Price was up over the daily VWAP. So the bias was clearly up.
Okay, so you're expecting a big move up. Easy.
Right.
Just jump in and buy.
Well, that's where the tension comes in. Everyone wants to catch that big ride up.
Yeah.
But there was this massive offer zone sitting right overhead.
A concrete ceiling of sell orders.
Basically, yeah. It's the classic trader's dilemma.
Yeah.
You want to go long, but you absolutely do not want to buy right into that brick wall.
You have to get in low.
Or not at all. And that brings us to trade number one. The price pulls back to the SD1. That's the first standard deviation support level, and it lined up perfectly with their dynamic trend zone.
So they took the long standard entry. But let's talk about the risk management, because I see they placed the stop loss 1 VF away.
Yes, the volatility factor.
Can you just briefly explain that?
It's just a dynamic unit of measurement. So
Sure.
instead of a random, say, 10-point stop, your stop is 1 unit of current market noise. It keeps you from getting shaken out by the normal market wiggles.
Okay, and this is the part that really surprised me. The trade starts working. It's moving up toward that offer zone. Normally, this is where you'd hear someone shout, add to your winner. But this trader did nothing. They just sat on their hands. Why?
That is the discipline of not adding. It's pure math. The target was the RP1, a resistance pivot that was inside that concrete ceiling we mentioned.
Ah, I see. So the price was already too close.
Exactly. If they added a new contract, that new position wouldn't have had enough room. It wouldn't have that 1 VF of space before hitting the target.
So you'd be taking on risk for almost no potential reward.
You'd be entering a trade with negative expectancy, so they just let it ride, and it hit the target for 188 points.
Which was incredibly smart, because the second it hit that target,
Reversal, a complete hard stop.
the market just slams into that offer zone and rotates down, and we start seeing lower lows.
And now we're in trade number 2, the short.
And the management here felt totally different, way more aggressive.
It had to be. On the way up, they were driving into traffic. On the way down, they had open road.
So they enter short. But then look at this. At the daily VWAP, they take profit on 1 contract. That feels a bit nervous, doesn't it?
Not nervous, tactical. The VWAP can act like a trampoline. Price hits it and bounces.
So that was insurance.
It's insurance. They finance the risk of a bounce. But then, price smashed right through the VWAP.
And they added the contracts back. But this is the part I had to reread. They used a technique called combining stops. Can you break that down?
This is a masterclass right here.
They added a new short, but then moved their stop loss further away. It sounds completely backwards. You're adding size and increasing your risk.
It sounds counterintuitive, I know. But it's actually elite risk management. You have to shift your thinking
From dollars to
structure. The new contract needs its own breathing room, its own 1 VF of space. If you keep the stop tight to protect your unrealized profit on the first contract, the new one gets choked out by the slightest bit of noise.
So they moved the stop back, risking some paper profit on the first position just to give the new one the space it needed to work.
Exactly. They sacrificed a bit of P&L to preserve the structural integrity of the entire trade. And it worked. They didn't get stopped out, and they trailed that combined stop all the way down.
For a 354-point profit.
A huge move.
So that's the big takeaway for me. Trade 1 was about restraint because of that ceiling. Trade 2 was all aggression because of the open space below.
Context dictates management. You
Yeah.
can't have just one style. You have to read the road.
Plan your trade, trade your plan. We just saw it in action.
We did. And if I can leave you with one final thought,
Please.
stop looking at your P&L when you're in a trade. This trader was successful because they cared more about the VF, the math, the structure, than the dollar figure in the corner of the screen.
Structure beats P&L.
Every single time.
A painful but necessary lesson. Thanks for diving in with us today.